Today, it's planet Earth. Don't expect anything to make sense. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. It's Friday, and I have Tarric with me once again. Hi, Tarric. How are you going?
Not too bad, mate. How are you?
Good, but I'm confused. There's too much going on. There's too many counter currents going left, right, and centre. RBA lifts, Bank of Canada lifts, interest rates going higher. What a world we live in.
Yeah, it's kind of strange, isn't it? We've gone from, this sort of, everything's going to be fine narrative to now you've got HSBC and Commonwealth Bank coming out this week saying, well, it's a coin flip whether or not Australia goes into a recession later this year. So it's certainly moving at a million miles an hour.
Yes, and Phil Lowe, actually, in one of his outings, did say that they probably did too much early on through COVID, quote, as an insurance, unquote. So they're trying to sort of unwind that. But, around the world, everybody is now saying, actually, this inflation thing, it's not transitory. Do you remember transitory? It's now embedded. It's getting stickier. These are the current words. And even markets now are beginning to realize that, there's probably not going to be any cuts in rates unless, the R word really hits anytime soon.
It's certainly looking that way, and I think one of the interesting things going forward is going to be how these base effects that we got from the war in Ukraine, from that surge in inflation that we saw last year, are going to now fade. But I think one of the really fascinating things is, like, say for example, even if you see some sort of relatively moderate US CPI prints in the upcoming months, you could see headline US inflation hit as low as in the threes somewhere, yet that's going to be temporary. That is actually going to be transitory. So you're going to see, even if inflation moderates at like 0.3%, 0.4% month on month, you're going to see inflation re-accelerate. And I've been looking through US inflation data going back, more than 50 years, so just through the day. And I haven't seen that happen before. But, if that's happened, during an inflationary episode, usually that's meant that there's more inflation to come. I'm not sure that's necessarily the case this time, but it just proves how different this cycle is to past inflationary cycles.
Well, there was such a significant base effect early on because, of course, inflation, shot off very quickly, and that was partly to do with the energy situation. Of course, in Australia, though, the energy shock is still to come, right? Energy's looking as though it's still going to go higher. In the UK, food prices are up 19% year over year. And they're saying it's going to come down a little, but not dramatically. And it's interesting. Did you see the OECD actually said, well, there is actually this price gouging going on in some sectors of the business community. So in other words, some of the inflationary pressures now are actually profit boosting rather than actually just reacting to price rises. So I think this is a much more complex picture than, many people were thinking about early on. But the fact is that this inflation has now got to the point where the story has to be higher interest rates, assuming that you pull the monetary policy interest rate lever to quell it. I guess the question is the lever, the interest rate lever, actually going to quell inflation, or is it actually going to break the laws and, as you say, hike again later? I mean, there seem to me so many underlying issues here. And I still come back to the liquidity issue. Do you remember all of that liquidity that was thrown into economies around the world? And that was both through governments and also through central banks. The underlying cause of this inflationary cycle is not just Ukraine. It's not just energy. It's also this liquidity problem. And of course, the liquidity is, going away a bit, but it could be a long, slow grind.
Yeah, I think, the interest rates will eventually work, mostly just due to the fact that eventually they'll cause a recession. But I think the question is, and, this is something that you and I have been talking about for quite a while, but the question is, how much damage is inflation going to do before we get that recession? More historically, central banks have stomped on inflation at the first sign, mostly because they're rightfully concerned that it can cause serious damage before they're able to address it. And that's why, even if you look at, say, for example, like the RBA, the trimmed mean inflation rate has rarely been above 3% since the 90s. There's only been, maybe a couple of years cumulatively when that's actually happened. But the RBA has stomped on it, so it didn't get above there for over a sustained period. And that's what they've done historically. But this time they were just like, no, don't worry about it. Everything's going to be fine. And obviously that hasn't worked out very well. And I think that's really the problem this time that's going to make this cycle different to say, for example, 2008, particularly here in Australia, because unlike 2008, after we came off, the best part of a decade of strong wages growth and real wages growth, I might add, this time we're coming off the back of weak wages growth. And not only that, but we've come on the back of losing 14 years of household purchasing power. So that's going to be something that's going to be much, much harder to deal with, if we do end up in a recession, because all that purchasing power is gone. A lot of people are using up credit capacity now, and they're burning through their savings, and all these things that normally would help power an economy out of a recession are gone or significantly diminished. So I think that's going to be a real problem here for Australia, because the RBA waited too long, inflation got too embedded, and they just did, as Lowe rightly said, they did too much.
Yes, and of course the story is also from the RBA. We're trying to balance the keeping unemployment really low. We wanted to take a benefit of that low unemployment, but of course there are consequences. A couple of other consequences. The first is, of course, that GDP per capita went backwards this time around, as reported. And did you see the ABS came out today and said there are more people now with multiple jobs? So the only solution that people have is to actually end up working longer or working in multiple jobs to try and get by. And that's why the hours worked is going up. But that's not necessarily a positive thing. It just means that the only thing that people have in terms of options, because as you say, they've actually maxed out their credit cards now in some situations. The only thing they can do is to try and get more work. And I suppose the unemployment rate being low means there are jobs out there, even if they're not very salubrious jobs. But it doesn't bode well for the next 12 to 18 months as the interest rate cycle continues to go higher. And a CBA came out yesterday and said there's a lag. There is a lag of several months between what the RBA does and it really hitting real mortgage holders. And so their view is that later in the year, the real bite will come through as the rate rises come through.
I think in some ways, by the end of this, people are going to be wishing that we got a recession last year.
Yep.
I think that because, so much damage is going to be done. Rates are going to have to go so much higher than they otherwise would have if they just stomped on it really, really hard to begin with. And I think a lot of the criticism of Phil Lowe at the moment is misplaced. I think a lot of it really should be directed at the government. But I think that the issue is that what they should be criticizing them for is creating the situation that we find ourselves in. Because if we had say, for example, RBNZ style approach to we are going to crush housing prices and then salt the earth where they once stood, people wouldn't be piling into housing the way they are now. There wouldn't be FOMO. There wouldn't be fear of missing out. There wouldn't be all these different things because people believe that the RBA isn't going to let anything truly bad happen to the housing market. And they believe that the government isn't going to let that happen. Now, I think, in fairness to people who hold that view, that is what has happened historically. We're seeing that even now with immigration being ramped up to 33% higher than its previous record. And not only that, but even next year, after the impact of the base effect of returning students has faded, it's still going to be bigger than the prior record high. So I think it's going to be an interesting one in that regard, because monetary policy doesn't work the way it should, because instead of people battening down the hatches when they hear the potential about a potential recession, or they hear about higher rates, they just go, no, it doesn't matter. They'll cut rates, everything will be fine, everything will be hunky-dory, just the same way it's been for the last 30 years.
The old extend and pretend, of course, which is what we've had. And by the way, APRA, of course, is saying, well, you can go around the 3% buffer if you need to, and in certain circumstances. So I think there's blame for APRA here as well. I think because they're part of the problem. I agree that the government also partly to blame as well as the RBA. But it's interesting, isn't it, how everybody's standing back and saying, well, Mr. Lowe, what have you done? It's almost as if everybody else is just captive and passive, and it's all the RBA's fault.
it's kind of insane, really. Like the government helped this. They had the unlimited super withdrawals. When I say unlimited, I mean like they had no idea how many tens of billions would be withdrawn. It was just sort of just like, oh well, that'll do. Panic policy. And there's been all these other different policies which have helped drive this inflation situation, which have really backed the RBA into an absolute corner. And yet Lowe gets the blame. And I think that shouldn't we be blaming him for giving out the $188 billion in the TFF, which is costing the taxpayers money on the revenue that we get from the bonds that the RBA holds from the federal government? I mean, really, shouldn't we be blaming them for that? But no, that's perfectly fine.
Well, the TFF was a nonsense from day one. It was, it was just one of those additional things. But of course, in the scheme of things, if you think about the trillions of dollars that was thrown about the place, on globally as well as locally, everybody was on the same. Well, you've got to save the world, economy, et cetera, et cetera. And now we've got the inflation genie out the bottle. Absolutely. The Fed next week probably will lift again. I know that's what I'm reading into what is going on there. The Bank of England is looking as though they're going to lift, the ECB also as well. So the lifting cycle has further to go. And I agree with you. New Zealand is definitely the most transparent in terms of actually dealing with it, and they are very, very clear that it is necessary to force a recession through, even if it's a relatively mild recession, to try and get things under control. Whether they'll be successful, of course, is a different question. It's tricky times, and I come back to the the real households, because of course we've got about a third of households with no mortgage, no worry at all about higher interest rates. In fact, they're enjoying the higher interest rates on their savings. Those people are still spending. You've got a third of people in the rental sector who are actually finding it really tough now. I see that in my surveys. And the third of people with mortgages, not all of those with mortgages, of course, have big mortgages, but a proportion do. And so we've got this unequal distribution of the pain. And I think this is the really hard conversation that I'm not sure anybody wants to have, and that is that the pain is not equally being shared across the country. We've got particular cohorts of people, younger people in particular, who are actually bearing the bulk of the pain. Why? Because they're more leveraged and they've got property and mortgages and things. But there are others much less exposed to the pain. And I guess the question is, what's going to break first?
Yeah, and I mean, I understand why people are annoyed with the RBA. I understand that they're pissed off that, this is the largest relative rise in rates in history. If you factor in, it's the largest relative rise in history, and it's also the largest rise when you factor in the amount of debt, and then it just goes up into the freaking stratosphere. And I think that is it unfair in some ways? Yeah, it is. But the RBA only has one lever, and the federal government are unwilling to use the plethora of levers that they have at their disposal to be able to address the issue. So, it's just one of those things where it's just a case of it is what it is, because doing something is better than doing nothing. And then, you end up having a recession anyway. And, just on the topic of New Zealand for a moment, we're growing our population at an absolutely enormous rate here in Australia. That's, the RBA reckons its population growth will probably run about 2% this year, which is very, very high. It's it's very nearly sub-Saharan African levels of high, higher than some countries actually. But I think it's funny that the New Zealand economy isn't faring too much worse than ours on a per capita basis anyway. Yet they're taking a wrecking ball to their housing market, and well, I got to say, their housing market has very nearly had a US level fall in some places, and it doesn't look so bad.
No, indeed. Yeah, it's an object lesson. And, I have to say I quite like listening to Adrian Orr, because he's just, much more straightforward and transparent about what he's doing and why he's doing it, and what the impacts will be. I still get the feeling that Phil Lowe is rather formulaic and, rather academic at one level, but also not necessarily recognizing, other than paying lip service to, but not really recognizing what's really going on in the real economy. And that's a problem, because of course, real ordinary Australians, well, they are getting hit over the head by a 4x2, and it's not going to stop anytime soon. And I guess that's the other point: is this is a thing that's not going to get solved. We're not going to see interest rate cuts through the second half of this year. I mean, even the ASX, estimates of where the rates will be are now saying, well, it'll be 4% the end of next year. So this is going to be very significant and a very long-term grind, I think.
Well, I think the thing is that, even if we do manage to tame inflation, even if we do get it back to target, and even if interest rates are cut, at some point in the next couple of years, that's not going to fix or bring back the lost household purchasing power that's gone. And while there are other factors which have shifted in the economy's favor, say, for example, the explosion of spending by older demographics, which has just, really taken off in a big, big way over the last, since the economy's reopened following the pandemic. The question is that going to actually be enough to really refire the broader economy, or is that just going to be enough to keep certain segments going while other parts somewhat, just wither on the vine? And, I think it's also just even worth noting as well that, even just talking about your surveys and what people are doing in terms of equity, mate, that's still flowing into the economy as well. So if we do see a recession and a serious contraction, whether it, whatever that's driven by, I think things could get quite challenging in that regard.
Well, the equity mate's interesting because it's still there. And now the number of banks are actually encouraging people to withdraw sufficient equity to be able to cover the costs of the mortgage over the next year or two. Now, the interesting observation on that is, well, will people be disciplined enough to be able to pull that money out and hold it and use it to support their mortgage, or will they actually use the funds to, buy that use or whatever it is, or go on holiday? I'm not sure that people are as disciplined with their finances as perhaps the lenders are hoping, but more people are definitely pulling money out to be able to pay the mortgage.
Yeah, I mean, I think that's really the key point in all of this is that, we don't know where the story will end, because what we're seeing right now is rather unprecedented. We've seen consumer confidence collapse to the same levels that, to the lowest levels on a monthly average basis since the height of the 1990s recession. Yet you still have demographics out there, depending on the age demographic, whose spending is growing by, double digits, well above inflation. So, it's a really difficult one to sort of understand, because none of this has happened before, because those demographics didn't exist.
Very different, as you say. Well, you've got some charts. We probably should spend a bit of time in Chartland.
Yes, we do. We have charts and we have questions. Okay, well, we've got the usual little cartoon, and for those who want to look at the charts or support my appearances on DFA, you can look at that at avidcom.substack.com. The charts will all be there. If you want to have a look, that'd be great. Now, I thought rather than starting with a question, we're going to start with story time this week. Now, I grew up in a low socioeconomic area in the outer suburbs of Melbourne, and there was a lot of people who weren't that great with their money. And, this was at a time when the sort of the deindustrialization of Melbourne was undergoing, and, people worked in factories and things like that. So, things got quite challenging at times. So I learned at a relatively early age about the merry-go-round. Now, the merry-go-round is, as my dad calls it, is basically the way to pay the smallest amount of money, but keep the bank and your creditors away from the door. You just, you give them a little bit, you give them a little bit, you basically make a good faith effort to keep them away from to basically, keep the plate spinning until you can get some equity, mate, pay them off, and then start the whole process all over again. So I think that there is a lot of scope for people to do that in 2023. And, unlike the 1990s, where the banks could be absolutely punitive with repossessing houses and, taking you to town, taking you to court, foreclosing, etc., things are much more extended, pretend, and happy-go-lucky, rainbows, puppy tails, and fairy tales. So I think that there's a lot of scope for that. And I think that there's also just a lot of scope for Australians to turn to more traditional methods of credit rather than what they have in recent years, which is buy now, pay later. And as Martin mentioned before, there's still plenty more scope for them to get into the old equity mate pie, because I did a little bit of a check just before on data from the RBA, and the ABS, and Australians have about $7.4 trillion worth of equity to tap. So even tapping a tiny fraction of that equity wouldn't be able to keep the plate spinning for quite a lot of households for quite a bit longer. So without any further ado, I shall get into the actual charts. Now, this is credit card debt as a percentage of GDP. And as you can see, it peaked following the financial crisis. Now, it's fallen now by more than half of where it was, but it's also worth noting, this is what it looks like overall. In terms of balances that are actually accruing interest, that has fallen off a cliff compared with where it was back in 2008 and 2009. So there is a lot of scope for Australians to get into a lot more credit card debt before we're even at the peaks of where it was in 2008. So if Australians want to turn to credit cards to keep the wolves away from the door, or to keep on spending for a while longer because that rate cut is just around the corner, they can.
And of course, the US is showing the same trend, right? Their credit card debt is actually now rising for the first time in quite a few years as more people turn to credit as a short-term stopgap.
Yeah, exactly. So I think that there is a lot of scope for consumer credit to be turned to if that's what households want to do. And I think that's why it's so key to just try to understand the psychology of what's going on. And I don't think anybody truly does. I don't understand it to the point that I would like. I mean, I understand it to a degree, but much of that is very much from a theoretical perspective.
Absolutely. Well, I mean, it is tough. And I see it in my surveys that, the households have cash flow problems. So what do? Well, they tap into savings. They change their spending patterns. So, the data showed less discretionary spending, more, must spend categories growing. But they also have access to various forms of credit, and that's including the buy now, pay later and credit cards, but also other types of loan and equity mates. So there are levers that can be pulled. The issue is, will the lending processes start making it harder to do that, or will the lenders just keep extending and pretending some more? Because, of course, what lenders want to do is to lend more.
Well, I think, part of me wonders if we've already got a bit of an answer from APRA today, in the sense that it's just like extend and pretend.
Yes.
It doesn't, your loan doesn't fit the rules anymore. Well, we'll just change the rules or bend the rules or suspend the rules.
Yes.
And then we'll, so...
as Lindsay Davis said, I saw his tweet, he said, hey, going along 140 Ks on 100, well, what's the problem?
Yeah. Yeah, no, it's like if they're just going to let, wave this stuff through, realistically, it will keep going. And I think it's going to be interesting because the thing that could really put the clamp down on that is external funding pressures and rising costs. So the TFF roll-off is going to be a bit of a hurdle in that regard. But if we do start to see external funding pressures spread into the Australian banking system, that is where things could get a little bit more challenging. Although, we haven't seen any major signs of that yet. We've seen a few issues here and there with some of the smaller non-bank lenders and residential mortgage-backed security issuance. We saw some delayed issuance and higher yields on those during the US banking crisis, but still it's very, very minimal relative to something that would really rock the boat.
Well, I think banking liquidity more generally, whether you look at the US or Australia, is one to watch, because I don't think that the regional banking crisis is over as interest rates are continuing to rise. The funding pressures will build. And the other point there, of course, is that if people start getting twitchy about banks, they're going to pull their savings out. And of course, the banks are reliant on savings. So I think there's a liquidity question. And look, you might see a TFF version 2 come through because of the need to square the circle.
Yeah, well, I mean, I think it'll just be a question of what they fear most. Do they fear wrecking the dollar, or do they fear letting a wrecking ball get taken to the housing market?
Yeah.
And I think we both know the answers to that question.
Well, financial stability, of course, comes first, right? And that's why APRA has done what they've done, and, they can then say everything's fine. And so there's no financial stability risk. And that's why keeping the housing bubble going as long as possible is another critical issue, because if house prices really started to fall significantly, then that would put huge pressure on the banks, and the risk of financial stability then goes through the through the ceiling, I guess. But the bottom line is the financial stability risks were built post 2008. So this is a long-term problem that nobody wanted to address. And it's finally now coming to a crystallization point. And like you said earlier on, nobody quite knows how it's going to play out. But to my mind, financial stability actually now becomes a very significant factor in the mix.
Indeed. Okay, next question. Liam asks, what historic comparisons can be made between the time in the run-up to the Spanish flu and the run-up to the pandemic? So if you want to take that question, or I can do it and we can move on to your answer. It's obviously a big question.
Yeah, you go first. I'll add some comments.
Okay, well, it's kind of interesting because in the US and Australia, towards the end of the 1890s, there was issues with. The US had a depression. Australia had a fairly major land bubble bust in the 1890s, and as you can see there from the chart on the right, Australia at the turn of the 20th century also had an issue with surging unemployment. Now, the US also had surging unemployment as well, as it also endured multiple recessions through that period. So, I mean, in a way, you could say that it was somewhat similar to the financial crisis, because it did prompt profound change in the US and around the world, because that is one of the reasons that those issues, those depressions and repeated recessions, as you can see from the jumping up and down there of the US consumer prices, as a result of those various economic cycles, it drove the creation of the Federal Reserve and the central bank system that we know and moderately tolerate today. So I think that there are some similarities in that sense, because it broke the paradigm that had defined the 1800s and the very early 1900s, in the same way that 2008 broke the paradigm that ended up, basically destroying the normal monetary system as we know it, and we basically all started pretending that, QE was perfectly okay, and all these other sort of, how would you say it? Just all these things that were just papered over. We just pretended that everything was fine, and say for example that Greece is going to be able to service its debt till kingdom come, or that that Japan isn't going to keep borrowing money until the sun burns out. So I think that there are some similarities in that respect, but in terms of what followed, I don't think that there's sort of much similarity in that regard, because you did see the big run up in inflation following the return of the troops, but then you also saw the collapse in inflation because of the Spanish flu, and our inflation didn't collapse quite as much, and when the economies did rebound, the inflation wasn't nearly as bad as it is today, because you didn't have people and central banks throwing around all sorts of silly money.
No, I think the liquidity story is very different now than then. I think that there was much more concern in the earlier cycle about sound money and needing to protect sound money. And whilst the story at one level looks relatively similar, I think when you delve into it, I think we've taken down a completely different turn this time because of the liquidity. The government, central banks around the world, and even, as we said earlier on, you can grab superannuation, all of those things. Those were levers that just weren't pulled to the same extent last time around. So I think I go back to the reason that we've got this inflationary problem is because of, since the global financial crisis in 2008, central banks and governments around the world have been irresponsible. And that irresponsibility wasn't as apparent in the earlier cycle. So I think it's a bit different because of that.
Yeah, I concur. I mean, I think one of the really interesting things is that there are countries who were less aggressive with monetary stimulus and less aggressive with fiscal stimulus, mostly in, say, for example, in Asia, places like Thailand or Indonesia, places that now have very low levels of not very low, but adequately low levels of core inflation and still relatively robust levels of economic growth, because they didn't go overboard. But even looking at some countries that did that that did have like fairly sizable responses, but then came later to the party, but earlier than the rest of the world with monetary tightening, say places like Brazil, that are now getting their inflation issue under control more swiftly than the rest of the world because they did act early and they did act aggressively. And I think in a lot of ways, Brazil's policymakers deserve a lot of credit for staying out of the way because there is obviously a lot of undercurrent of issues with corruption, issues with interference, etc. Stuff like you see in Turkey, for example, but they allowed their central bankers to do their job properly. Now, I think here in Australia, for example, I think Phil Lowe probably felt quite a bit of pressure, whether direct or indirect. That's a matter for the historians, not to do his job aggressively and not to do his job properly.
No, I agree. And interesting, if you look at some of the Scandinavian countries, particularly, who had a different COVID response and just didn't flood the economy with so much liquidity, they are in a much better position from an inflationary perspective, which sort of validates my hypothesis that a lot of the issues we're dealing with is because of the central bank's bad policies and government bad policies, over the last decade or two. So there were alternative paths that could have been trod, but of course that would have involved not inflating the economy by inflating housing.
Pretty much. I don't really have anything to add to that. No, this chart just illustrates nicely how the US basically went through multiple very, very large boom bust cycles during that period in the run up to the Spanish flu and to the turn of the 20th century. And just, sort of how there is that precedent that drove that change.
Absolutely. And I think it's important to understand that the concept of keeping unemployment down at a very low level for a long period of time historically has never been achieved.
No, I mean, there's the post-war period, and Australia did very, very well on that. We managed to keep unemployment with a 2 or a 3 or a 4 handle for the best part of almost 30 years, and I think I suppose it is possible, but I think I think a lot of it. I think sometimes we attribute to skill and to planning, which is something that we might be better off just describing to luck rather than anything else. Just the luck of the demographics, the luck of the stability of the post-war environment, all those different things just came together at the right time and produced pretty solid conditions.
Plus, of course, the ongoing redefinition of what employed or unemployed might mean.
Yeah, exactly. And not only that, but I mean, it's like you could make the same argument about inflation.
Yes.
That's why I don't bother doing direct comparisons to the 1970s to now, because they changed it all so much that it's. I mean, even the National Bureau of Economic Research in the US, which is like a government organization, all but a government organization, basically said no. Look, they're pretty much the same now. Like this percentage in 1973 is pretty much the same as this percentage in terms of the peak today. So, but it is what it is. Okay, this question is from Leo. What's the leverage in the residential housing market, and how has it been over the years? The chart, I think, pretty much answers the question. Unfortunately, I don't have data prior to 2011 for the total value of housing stock without having to go through absolutely everything and then compile it all on a state-by-state basis. But that is from the beginning of the ABS data series on total overall value of housing stock.
Yeah, and it's worth underscoring, of course, the two variables there. One is the value of housing, which of course did accelerate. We hardly had any correction through the global financial crisis. And so we started in 2012 with quite high house prices, and then house prices continued to rise. We had a couple of minor corrections, but nothing major, particularly when APRA changed the rules with regard to investment lending. The debt is also very important to understand because, of course, you've got historic debt, but you've also got new debt. And one of the things that's worth doing, you haven't got it in this chart, but I haven't got it available now, but is to look at that broken down by the age of the loans that are actually made. Because what is absolutely clear to me is that you've got quite a lot of people sitting on significant housing value with almost no mortgage debt from years ago. But you've got a huge concentration of people sitting on massive mortgage debt with significant housing value and no loan to value equity in it. So you've got this weird distribution problem that the aggregate numbers don't actually expose.
Indeed, and I think that's going to be something that's going to be interesting to watch and to see over the coming years in terms of the retirement of baby boomers and boomers paying off their mortgages as they retire, as they unlock super, and as they try and pay things off and get their debts low as they try and qualify for aged pensions. Because I think the thing is that, like, say for example, I know a couple who just recently paid off, their boomers, on the cusp of retirement, they just paid off their mortgage, and their house is worth $2.5 million. Yet, up until recently, they owed about $5,000. So if you think about, like, as you say, the ratio of actual debt to equity or debt to value in this instance, it's pretty easy to see how a bunch of older loans hold an absolute shed load of value, but not a lot of debt.
And that's the point about equity mate, right? Because if you are actually in that category, you are able to go grab some more of that, whatever you want to do, whether it's a trip around the world or whatever, right? And that means that cohort continues to consume, which is going to actually put potentially more inflationary pressures into the system rather than less. So this is this unequal discussion once again, right? So because of the debt footprint and the equity footprint and the total value that people are holding, we are, creating a very polarized society.
Yeah, and I think that brings us back to something we were just talking about earlier on in the show, is the sense that, okay, let's say housing prices fall by 30% or even 40%. For someone who bought their house for $100,000 and it's now it's going to go from 2.5 million down to 1.5 million, they're still up so much that it doesn't, and they never had any intention of selling the place, so it doesn't really matter. They've still got this enormous amount of equity that they could unlock, and if they want to keep spending, if there's that psychological drive to keep spending, then they will. So I think that if something has changed in the mindset of Australians overall, particularly those with the equity, that they can unlock, is that just going to be an inflationary pressure going forward? And is that just going to entrench the two-speed economy between people who can unlock equity, who do have these big superannuation balances, versus the people who've just seen 15 years of their wage growth erased, who are just trying to scrape by saving a deposit or renting a place? So, I mean, are we just going to see that embedded inequality continue, where only a few people get ahead compared with more people who could have prior to the pandemic?
Well, I think that's already happening. So I'm certainly seeing, and if you look, I think, a couple of weeks ago on the show, you showed the issue of cohorts and the wage growth or lack of it, and the fact that the younger people had more significant issues. So they were going backwards there. They are also the ones with the big debts and the little equity, relative to people who are older and therefore perhaps are sitting on a bigger pile, even if it's a theoretical pile. Remember, of course, that the value in your property is only on paper until you actually come to trade it, and then you will know what the real value is. So we might find some unfortunate surprises for some people, but nevertheless, if you've sat on a property for 20 years, it almost doesn't matter, because even if it drops a bit, you're still actually up dramatically. That's part of the issue. And I guess it goes back to the question, is if you actually predicate the whole future of a society on the ongoing elevation of home prices, that's a problem, because ultimately the risks are not being spread. It's actually all into one category.
Yep, and I think that's what we're going to discover in the next year or two. We're going to see, that those cohorts, because I think the thing is that it's all well and good for, people to get on their high horse and say, oh, but the mortgage holders. No. There are mortgage holders out there who are still paying less than half their original interest rate on their loans, who are still laughing, at the fact that their property has, double, triple, quadrupled in value over the time that they've owned it. So, there is don't get me wrong, there is a sizable minority of people, probably, maybe up to 40% of mortgage holders, maybe more, who are going to have serious issues. But that's only maybe, let's be generous. Let's say half. That's 16% of the 16.5% of the population. There's still the other, 83% of the population who aren't impacted by rising interest rates, are either aren't impacted by rising rates or are minimally impacted by rising rates. And I think that needs to be a very key part of the conversation going forward, rather than just, oh my God, the rates are rising and everyone freaks out.
Well, I'd add the 16% or, whatever it is, plus, of course, the around of 30% of those in the rental sector. So I think you need to bucket those two together, because that tells me that roughly, give or take, roughly half of households are in financial strife or close to it. The other half, for various reasons, either have no mortgage or they have very limited mortgage, don't have a problem. And, it's interesting that if you look at my overall financial stress analysis, which is an aggregate of mortgage stress, rental stress, and investor stress, it's roughly 50-50. So we've got half of the economy, really struggling, and half of households in the economy actually hardly noticing.
Yeah. And I think that, that's what I'm sort of trying to get at, in the sense that, you do have those mortgage holders who are suffering. And I do concur that there are other options that should be explored in that from the fiscal side. But I think the thing is that, as you say, there are these renters, there are all these other people, there are even people who are homeowners who are, say, for example, elderly or disabled or, in working lower paying jobs, who are still struggling because of the cost of living. And that is what rates are trying to address, and I think that, so much just gets lost on but the higher rates, when what we should be saying is, okay, the higher rates, but what about the destruction of household spending power?
Yeah.
I think that really doesn't get the airtime that it deserves.
No, I think there's two reasons for that. One is it's a more complicated argument. As we've tried to explain, it's driven by a number of different factors. And two, it's quite hard to directly respond to it, other than for those people trying to get wage rises. So the solution is less easy to articulate, whereas, of course, just saying, well, cut interest rates, that's a simple blunt instrument, or lift interest rates, that's a simple blunt instrument. So the media, unfortunately, doesn't do a very good job of, I think, getting into the more complex issues that we're touching on, which actually is the real conversation that should be going on. I'm just, annoyed and surprised that it's not really a conversation that I see very much at all.
Well, I'll do my darndest to get it out there, but at the end of the day, I'm just one journalist. Okay. Okay, we've got a question here from Tom. Is there a precedent to residential property sales volume remaining so low for so long, thereby supporting property prices? What might prompt more sales?
Well, you can see the chart there. Turnover rate is very low, and it's been like that. The listings are very low. I made a post the other day saying this could be about to change, and there are three reasons why I'm making that point. Firstly, we're now getting to the point where people are beginning to realize that interest rates are not going to get cut anytime soon. So there were a lot of people saying, well, we can cope for a few months because, rates are going to drop. So let's just keep going on. They are now beginning to say, well, hang on a moment, maybe we should take some proactive activity, and that could include selling. So we might list our property. The second is you've got some property investors who, despite trying to put the rents up, aren't getting sufficient to recover the increased costs because of the mortgage rates that have gone up and are going up. And so some property investors are actually shedding some investment properties. I reckon about 20% of investment properties have already left the stage, as it were. There are more investors potentially looking to sell. Another reason why they're looking to sell is because there are rules and regulations that have come in, which makes it more expensive to maintain and provide the adequate facilities in the rented property, things like fire alarms and other things. So property investors are actually beginning to sort of get a bit nervous. The third element is, well, there's a bit of a spike in prices in some areas, particularly in Sydney. And so if you believe that property prices are up but going to drop, then you might, and you were thinking potentially of down trading or otherwise shifting, you might decide to try and list early rather than later. So some of those factors, I think, could lead to quite a different trajectory for listings over the next few months. And if that happened, then you would start to see the number on listing rising, property prices beginning to fall, supply demand. And that could be quite a significant tweak. As Edwin says, you don't need a massive change in the listing numbers to have a very profound impact on the actual home prices.
Yeah, I concur. I think that there is, that potential there. And, I would also just add that, there's also the issue of the rental crisis. When the rental crisis does begin to normalize, hopefully, later this year, that is going to take a lot of pressure off of the housing market in terms of, people not wanting to sell because of being, stuck in purgatory in terms of being able to try and find a rental while they were between places, or, perhaps they can't find a house they want, but they get a good price for theirs. It gives that flexibility and that level of options. But, on Tom's question, is there a precedent of low sales volumes helping property prices? Technically, yes. During the 1990s recession and the time that followed, low turnover levels did help to put something of a floor under housing prices, and they didn't fall off a cliff as they may have, if that wasn't the case. But I think it's also worth noting that this is 1990s housing, 1990 housing prices we're talking about. They're not overvalued to any significant degree. They're still very, very cheap relative to long-term trend. But it is worth noting that in places like Sydney and Melbourne, even after turnover began to recover, property prices did stay actually relatively flat for a number of years following that recession. Now, I think that that's probably down to psychology. It's also down to the way that the banks responded to the recession in terms of tightening lending. But, whether or not that will be repeated, if we do have a recession, is very much an open question. I think I personally tend more towards the view that Australia is now predisposed to boom-bust cycles in our housing market. Now, while I would love for it to be possible for housing prices to drop like they did in 1990 and then do nothing for the next 5 years, and that would be fantastic for, well, most people, I don't assign a terribly high probability to that.
No, I think it's going to be volatile, up and down over the next few years, partly because of government policies, both state and federal, partly because of migration, and partly because we've got ourselves into the situation where so much of the household wealth and therefore banking exposure is in the property cycle. So that we're going to see a lot of ups and downs. The other point, of course, is that the construction bust at the moment and the lack of approvals of new property means that there is going to be a limited supply of new properties coming on the market because the approvals are way down. And that's going to put another sort of cyclical element into this. I've never seen, I think, such a low level of approvals as we're seeing at the moment, not for many years. And that is at a time when demand, because of migration, is quite strong. So I think these cross currents are going to lead to significant cyclical lifts and falls. And we might see those lifts and falls not necessarily synchronized across the different geographies or indeed across the property sector overall. We might see different units and houses and those sorts of things in different areas moving differentially. So I think this is going to be a very complex picture. And of course, it's also highly politicized, isn't it? I mean, every time there's an election, you've got to expect that housing will be one of the issues in the election campaign.
Yeah, and to add to some of the cyclical issues that you mentioned, I think one of the interesting ones is the falling size of households. Now, I'm not talking about the sort of temporary moves, not transitory, shall we call them, moves that we saw during the pandemic, but instead the fact that household sizes are shrinking. not so much, it's all, there's this sort of narrative that it's like, it's because, young people are all moving out in droves and all this other stuff, and that's been the only reason over the last, say for example, 10, 12, 15 years. But there was an interesting study done into it. I think it was by Ben Phillips at ANU, who concluded that the reason why household size is falling isn't because the number of household adults per household is falling. It's because the number of children per household is falling. Because you're seeing the aging of the population, you're seeing young people, grow up, or you see and people are having fewer kids, so the household size is understandably falling. So I think that it's going to be interesting in that regard, because something that a lot of people haven't really considered, the full impact of, and I haven't seen something that has down into the nitty gritty. If you know of something, just let me know. And that goes to all of you viewers in the comments, even if it's for the US or UK or Europe, the same thing really applies, because we've all got the same demographic issues. But something that really figures out exactly how much boomers staying in these homes that are very large is going to have on the overall supply of housing, and housing demand, housing sales, all these different things. Now, I'm not saying that they don't have every right to stay in those houses. That's a debate for another day if you want to have it. But I think that, that is something that really does need to be considered, because I've been thinking about that myself for a few weeks now, and I don't have an adequate answer, and I haven't been able to find one in the data yet that's been sufficiently broad-based.
No, I haven't seen anything specifically on that. I mean, I do have data on my down traders, and I know that there's a considerable, more than 1 million households are expecting over the next 2 to 3 years to look to move into something smaller. And there are some drivers to that, one of which is to do with releasing equity to be able to cover retirement. But more broadly, it's because of things like health issues, or that they've lost a partner, those sorts of things. One of the other observations in the down trader story is that many people would want to live in a similar area to where they currently are, but can't find anything that would actually be appropriate in the area that they're in. So that creates a huge overhang from a demand perspective. And so people then decide to stay put for longer. I mean, there is the $300,000 down trader government scheme where you can put it in a superannuation to try and help people to sort of make that bridge. But I'm not sure that itself is going to be sufficiently powerful to be able to actually encourage some people to make those moves. And the other point then about this demographic shift is quite interesting, because if you actually argue that we're producing less kids in Australia, it's then down to where the migration story comes in, and what's the mix in terms of the migrants that come into Australia, and to what extent do they bring family, or will they have family when they arrive here? And in fact, again, in my data, I see that some of the bigger families are actually some of those first generation migrants. So, for example, I look at Point Cook and Derrimut. The average housing size there is quite a lot bigger, simply because of the ethnic mix that's actually there. So there's some interesting ethnics as well as actually demographics that are probably worth thinking about.
True. Okay, now this is just on a bit of an extension on that question about prompting sales. National property listings getting poleaxed. And I think it's also worth noting that listings are falling much, much more rapidly in the capital cities than they are in the regions. And obviously that's a generalization that, don't take it all the way to the bank for your individual area. But yeah, I think this illustrates nicely that basically, you are seeing, that the overall stock on market falling, and that very much supporting the property market. And just on the next one, new listings remain extremely, extremely weak. Now, it's CoreLogic have got the 5-year average there, which personally I would have chosen the 10-year average, but here we are. The 5-year average includes the pandemic, and it also includes the 2018-2019 period where listing volumes were weak because of the Banking Royal Commission. So, yeah, I think that things are actually worse than they appear in terms of the flow of listings into the market.
And I make the point that some of the listings are low quality property, like old investment properties that need a lot of work. And of course, a lot of the problem with getting older property is you've got to try and find a builder who can actually do the work and also get the materials. So what you're finding is that the mix is also quite interesting. So if you look at the properties that have been on market for more than, let's say, 180 days, they're going up, whereas the new listings aren't necessarily rising that quickly. So you've got a bit of a runt of older properties, maybe less good quality property that's hanging around. So the listings story is even worse than the headline story, which is bad enough.
No, I concur. I've seen that in SQM's data.
Yep.
Now, I think this is an interesting one because it sort of shows where we are at in terms of the impact of the base effects on US inflation, and where very much the headlines, I think, are going over the next few months. If we sort of see middle of the road prints in terms of 0.3, 0.4% month on month, which is, it's been, roughly, the middle of the road, we're still going to see inflation fall into into the threes. Maybe even if we see two, especially week month, maybe even into the twos very, very briefly. But then if things begin to reaccelerate even very, very moderately, you're going to see inflation bounce again. And the thing that really interests me about this chart and about the implications of it is how the Fed is going to change its messaging, adapt to this. Because at first, over these next few months, at first you're going to have headlines of, oh, inflation has fallen, it's back near 3% or 2% or 4% or whatever it is, and there's going to be a whole bunch of jubilant people going, we killed inflation, blah 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 blah. Those people will be wrong, but there'll still be a shed load of them. But then inflation's going to bounce, in all likelihood, even if it's only moderately. And the question is, what happens then? What does the Fed do? Do they then have to reconsider raising rates again because inflation expectations might take off again? Or how is the psychology going to play out? And I think this is something that the RBA is going to face, but in a slightly different, in quite a different way, but in terms of they're going to have a similar issue, but just in the sense that here in Australia, we're going to see things like, say, for example, the cost of new homes is going to keep falling on a year-on-year basis. Eventually, it's going to plateau. It's probably, from what I can see from the month-on-month figures, it's going to remain positive, and it's still going to remain elevated above what the RBA wants it to be. But those falls and the falls in other things like, say, for example, in petrol prices because of base effects, people are going to be like, well, we've beaten inflation, but then you're going to look at things like rents and electricity, which are going to be going up and present some rather significant issues for them. So I think that they're going to have a bit of trouble, like the Fed, with the messaging and exactly how they're going to go about it all. And I think that that's part of the reason why they have, sort of put the hammer down on the rate rises recently.
Yes, and I think in Australia, where you've got the energy cycle, which is still not reached a peak yet, but you've also got the wage cycle, and of course they're worried now. The RBA is worried about services inflation, and they're worried that what's happening overseas will happen in Australia too, and that is you'll start seeing wages growth flow into the services sector, and those are going to then put prices up. And I'll also make the point that there is still, I think, some evidence, and I don't necessarily think that people want to recognize this, that some of the inflationary pressures are actually price gouging rather than actually just passing on the costs. So corporate profits are still looking pretty healthy, much more healthy than wages growth, which is interesting at the time when, of course, the income that the government's getting from taxation is continuing to rise. So the GDP numbers show that, Australians are paying more than ever, thanks to bracket creep and all of those things. Whereas, of course, the contribution from the corporate sector is dropping. So there's a few issues, I think, that Australia is going to be faced with. And I think you're right. The narrative is going to be very complex to try and explain it all.
Yeah, I think that the RBA have an issue in that regard, but I think the government are going to have one too. As you said, the issues with taxation, particularly personal income taxation as a percentage of GDP and everything else. I think that they're going to have a bit of a problem in that regard, because how do they continue to justify all these generous tax concessions, on super, on all these other things? Now, it's all well and good to say, oh, well, those are the rules, blah, 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 we can't change them. Well, you're going to have to. My dad, who is a boomer, he came home from a seminar one night back in the 90s when he used to work in finance, and he told me, your generation is going to get shafted. I was about 8 at the time, but I listened very intently. And he basically said that, a demographer from the government came to talk to us about this and how it's going to impact the insurance sector and financial services and blah, blah, blah. And basically, boomers are never going to be able to pay enough tax to fund their retirement and their healthcare. It's not going to happen. Mm. You guys are going to need to pay a lot more than what we did, in short. And I think that we are reaching that point now. And we've already seen the degradation of services. If you want to look at, you look at ambulance ramping statistics, you look at hospital emergency wait time statistics, you look at the fact that bulk billing is collapsing for people who aren't concession card holders or children, and, without getting, too political and too into all that sort of stuff, I think that the government is going to have a serious problem in that regard, because they are going to have this backdrop of falling services, rising taxes, and then they're also then going to have to deal with the political time bomb that is the stage 3 tax cuts next year, which are the equivalent of, probably, in my bar napkinist estimations, about the equivalent of giving a 1.25% rate cut in terms of the impact on inflation. So, it's going to be a real tightrope for them to walk.
That's right. At a time when, of course, they've committed hugely to defence spending and other spending categories too. Plus, of course, the transition of the economy into something a little greener. And of course, it's worth just reflecting there that in the US, the Inflation Reduction Act has really sparked massive investment in the US, specifically around green solutions. So if Australia doesn't follow suit on some of those things, they're going to get left behind again. So, I mean, the policy choices are not pretty. And I'm not sure that Chalmers is going to be able to, turn around and say, well, we're going to have to put income tax up even more, not directly, but the bracket creep will just continue and continue and continue. And that means that people are getting to pay more, but it will not be sufficient. So cut services, what are you going to cut? Where are you going to cut? The NDS, what are you going to cut? That becomes the question, which actually then comes to the bigger question, which is, so what sort of society do you actually want over the next 5 to 10 years? Do you want a society like in Scandinavia, where there is a good social support structure? Scandinavians are paying more in terms of income tax, but the quality of life as a result of that is actually paying dividends in many ways. Is that the sort of society do we want? Or do we want a society more like the US, where effectively there is a proportion of people doing really, really well and everybody else struggling most of the time, and the haves and the have-nots just bifurcate? And by the way, corporate behavior actually rules the roost. I mean, there are choices, but the question is there the political fortitude to actually want to have those discussions, or will we just muddle through?
Well, as things currently stand, if I was to assess the intentions and the sort of plans of the two major sides of Australian politics, the Coalition and Labor, I would say that the Coalition wants to pursue policies that's going to see the Coalition in government for the next 10 years.
Yes.
And I would say that Labor is pursuing policies that's going to have Labor in government for the next 10 years. So, I don't, honestly, there are a lot of angry people out there about rate rises at the moment. And, the fact that I just find it just amusing, really, that the government is just so cleanly avoiding any of the dirt that's being thrown on Phil Lowe and the RBA is just hilarious to me. And not only that, but, Albo turns around and goes, you know what, not only all of this stimulus and, all these different things to stimulate demand, during the time we supported Scott Morrison wholeheartedly on, 95% of this stuff. We're gonna add to that by bringing in 400,000 migrants, which is going to put upward pressure on rents, which is something that Lowe and even, and Lucy Ellis and a bunch of other people from the RBA have been going really hammer and tongs on from the relative position that they have. I mean, Alex Joyner said it quite well today, just on Twitter, basically saying that, the RBA need to be in a position to be more vocal about these issues that are impacting their ability to execute their mandate. And I think that would be fair.
I agree. And the productivity story, of course, which has now come up quite a few times in recent conversations, Senate estimates, as well as in the Morgan Stanley address, is quite interesting, right? Because effectively Lowe is saying that you've got to find a way of increasing productivity if, in fact, you want to get some of these things to work. So they are trying, but I'm not sure how many people are listening. And of course, it's quite convenient for the government to be able to say, oh, it's the RBA's problem, not ours. And of course, the latest recommendation from the review of the RBA was to remove the government's ability to be able to actually intervene if the RBA decision looks weird.
It's the whole RBA review was really just misdirected. Shall we call it that? Like, they didn't address the issues that you and I and a lot of people in the finance and economics community had with their decision making, and instead focused on basically, this is why you screwed up for doing your job. Like, I realize that they stuffed up with messaging, and I completely agree with the review that their communication needs to be better, because frankly, it's crap.
Yeah.
Like the idea that they're like, we didn't say no rate rises till 2024. No, you just let, thousands and thousands of articles get produced, on, thousands and thousands of nightly news, stories on, no rate rises till 2024. Your job is to get out there, control the narrative, and do your job. That's what the Fed has to do, and that's something that they've struggled with, but admittedly they're working on. Whereas the RBA just like, they're just like a meme who just, sit there and just go, well, it didn't really work out. We did our best. And it's like, well, your best wasn't good enough, and you're going to have to do better. And I think that needs to be something that the review focused on a great deal more than, we'll get some outside people in to help make the decisions.
Well, the issue of accountability didn't really get any focus, it seems to me, and that was a major problem.
Accountability.
Yeah, I know, the novel idea, accountability in Australia, but also, of course, shifting the deck chairs and saying, well, we'll get this external board. Well, there are other central banks around the world who have, somewhat similar structures. They haven't made any better decisions. So why would it change the decision matrix? And the final point with regard to communication, it's interesting that Bank of New Zealand, Bank of England, Bank of Canada, Federal Reserve, they hold press conferences every time, and out there for about an hour, being bold questions from the journos. It's not happening in Australia.
Well, let me put it. I'm going to have to be really careful not to get myself in trouble here. The problem with some of those things, say, for example, in the US, I focus on the US, that way I can keep myself out of trouble. Yeah. The problem is that there are a plethora of journos who are chomping at the bit, scratching at the doors, trying to get into these things, to ask Jerome Powell big questions, to ask and I'm not talking about just people who have a blog or a Substack. I'm talking about people from, mainstream, enormous, multinational media organizations who just don't get let in to these press conferences, because it's like, I know you. I know what you're going to ask, and I know, because you've said it on Twitter, or because there's that tone in your articles, and we're not going to let you in. But we are going to let in all these other people who will then leak information to and help boost their careers.
You're beginning to suggest that maybe the whole system is a little bit less transparent and objective than you might suspect, which I would agree with, looking at the questions and looking at the answers to the questions, and the fact that quite often the answers are, ho-hum. But the whole question of transparency, openness, and disclosure seems to me to be a big question that central bankers around the world need to actually get better at, because, of course, just repeating the mantra, well, inflation is bad, we have to crush inflation, which is what they basically start every conversation with, and we know it's going to be painful, but we've got to do it. And interest rates is our lever. And by the way, quantitative tightening and easing isn't as good a lever. So interest rates is what it is. I mean, once you said that, you've pretty much, there's nothing else to talk about, is there?
No, and at that point, you end up like Phil Lowe, getting asked questions that aren't your purview and making yourself look like an idiot. Well, move in with your mate. Well, get another job.
I know.
And I mean, he has made himself a right scapegoat in that regard. However, as much as he screwed up in the past, he's pretty much made the same mistakes as Adrian Orr and Christine Lagarde. I mean, admittedly, Adrian Orr and the Bailey at the Bank of England have, ended up moving earlier, and credit to them for doing that. They probably ended up stopping too early in terms of the Bank of England, not aggressively enough, but at least they tried. But realistically, Lagarde, Powell, you pick a central banker, they're pretty much in the Western world, most of them all made the same mistake. And I just think it's funny that Lowe's being crucified now for doing his job, whereas, Powell's, dodging most of the flack coming his way. I'm not exactly sure why, but here in Australia, oh my God, Phil Lowe is public enemy number one.
Yes, and the media, of course, are piling in and actually misdirecting, I think, some of the accountabilities, but that's a whole new story.
Yeah, I mean, I actually wrote an article last weekend about, Phil Lowe was a bit silly to say supply when it should be supply and demand. But I mean, I have to concede that the RBA has been handed an absolutely impossible position. They've been handed a crap sandwich of a position by successive federal governments who just refuse to do anything about these key issues, and it's just like, well, and they just prod the RBA, do something, do something, pull the lever,
somebody else,
pull the lever. We want more housing prices, housing print to go brew.
Well, there, Tarric, that was a bit of a long one, but so many important conversations that we've covered today. And, I think the net conclusion is, as we said it right at the start, can't make any sense of this.
No, but we will keep trying on a roughly fortnightly basis for you viewers.
Absolutely right. We'll have to do what we can and try and explain and decode what's really going on. Tarric, thanks very much for all your work and your charts, and I look forward to doing it in a couple of weeks.
Yeah, me too, mate. Looking forward to it.
See ya.